Welcome to Hot Sectors with me, Punita Kumar Sinha. Here we take a 360-degree view of the sectors that have seen policy initiatives and analyze the challenges and investment opportunities that lie in them. Today we look at India's oil and gas sector, which is facing financial stress and regulatory uncertainty. In the current environment, rising subsidies has caused the implementation of fuel price reforms. But will this move be sufficient, and what more can be done to attract investors? I'm joined by S.C. Tripathi, former Oil Secretary, R.S. Sharma, ex-chairman of ONGC, and Sanjeev Prasad of Kotak to answer just that. Mr. Tripathi, let me begin by asking you, what is your view of the fuel price reforms announced to date, and what more needs to be done?
I don't know whether this reform that they have, so-called reform that they have suggested for diesel will really work throughout the year, because towards the end of the year the elections would get close, and in fact in the middle and in the third part of the year itself there would be some state elections. So if they were not able to do reform for last 10 years, 9 years, then how would they go about it when the elections are on the anvil and elections in the midst of the elections? So I suppose that once they have put it outside government control, they will keep it outside government control.
So you do not believe in control of pricing of LPG, diesel, petrol or gas?
Let us take LPG, kerosene, petrol and diesel first. These are refinery products and they come from the refinery, they are made from the crude oil. Now in these four products, I don't agree first on government controlling the prices, because there is no law under which the government does it. Number two, if government does it because it's the owner of those companies which do it, then I think it is a very bad way of running those companies. A better way would be to subject them to competition with the private sector also, and announce a subsidy which is upfront, say per liter on diesel and per cylinder on LPG and per liter on kerosene, so that the efficiencies will be put into motion. Now then we go to the gas. At the moment we are in strange situation when India needs lot more gas, and there are a number of gas prices prevailing, and government does not know its mind what it wants to do, whether it wants to pool and set a common price, or it wants to leave the gas pricing in the hands of the producers. And also government perhaps is not letting, to my mind, not letting the regulator which is in downstream industry to play its active and full role.
Mr. Sharma, turning to you, do you agree with what Mr. Tripathi is saying on the fact that the fuel price reforms are not sufficient?
No, I feel in a economy like ours, it is not possible to absolutely control the sensitive products. Especially I'll talk about the diesel, the kerosene, the LPG. These are sensitive products. Diesel, in fact, it does have an impact on the inflation also. So, to my mind, some sort of the subsidy support will be required for the diesel. For petrol, there is no need for any subsidy in petrol. So, I feel some balancing is required.
And what do you think of LPG prices, Mr. Sharma?
I feel there is a need to upwardly revise that LPG prices also in a phased manner, in small doses, like the one the government is doing currently for the diesel. I feel this is the right the strategy, this is the right mechanism. The same way, some tweaking, some adjustment for this LPG and kerosene also should be effected, but in small doses.
And do you believe that the diesel price hikes will sustain for the number of months that the government has planned?
Not really. If we are saying that 45 paisa per month, and current under recoveries on diesel based on the current exchange rate and the current crude prices is close to 9 rupees a liter. So that will require about more than 18 months to do that adjustment. I know at some stage some pressure will come. I feel once they reach a level of the total subsidy manageable at the level of 5 rupees to 6 rupees a liter, that is where I say that that requires the balancing. I feel that should be the right approach.
Well, clearly a lot more needs to be done on fuel price reforms. Mr. Tripathi, what do you think about the budget announcements on the shift from profit sharing to revenue sharing for the oil and gas companies?
India is not known to be a very hydrocarbon rich country. Revenue sharing therefore is not so attractive as profit sharing can be, because revenues start only when the people make discovery, and when they make discovery in difficult areas like India, then they assume that they would have cost recovery first before they start sharing. In case of revenue sharing, they will have to bid for revenue sharing from the very first day. Of course, I think they will be able to manage, but I suspect that the larger companies and the better companies will for some time not come. So that would be a problem.
And Mr. Sharma, what do you think about the shift in government's policy from profit sharing for these companies to revenue sharing?
To bring a better stability, to remove uncertainties, I feel in overall perspective, personally I feel revenue sharing will work out better. Only thing is, when the companies they bid for the revenue sharing model, they have to see that what they offer to the government in the form of revenue sharing, there they have to factor what is their exploration cost. They can say that for the say first 5 years of the production, they would not like to offer any revenue sharing with the government. So during that period, they recover their exploration costs. So only thing is that will amount for them to do more deeper calculations, but it is feasible, and in the long run I feel that is going to be more sustainable model, especially looking to the current disputes we are having on the production sharing regime, especially for KG D6 the production and the role of the CAG and all. We will be able to avoid all these concerns, uncertainties, ambiguities, apprehensions.
So Mr. Tripathi, are you concerned about India's fuel security?
We were earlier being told that they are going to set up a sovereign wealth fund to look at acquisition of energy resources outside India. As I said earlier, we are not very happily positioned in so far as the hydrocarbon resources are concerned. We have less than 1% of global resources, and we have 16% of the population. So we must go and access resources outside India. China has been doing it rather successfully for the last 10-15 years. We have not been successful. China has, firstly, they were very aggressive. Secondly, they had much larger resources, and they have gone all over the world to do it. We, for various reasons, our decision making is difficult, and we have not been so aggressive. So we need to be aggressive.
But the exploration activity still remains very low in India. What does it do for fuel security for India?
You see, I was talking to one of the major global service provider, and there are two major service providers, where the Schlumberger Schlumberger gives all the technology supplies to the industry, and the Transocean, they provide the rigs. They say in China it hardly takes any time for the decision to be taken, and they are themselves surprised how the decision taken so quickly in China. Maybe there the decision making, there are not so many checks and balances, there are not so many accountability, there is not so many constraints in respect of tendering and nothing but tendering. So they are able to procure the services, they are able to procure the rigs much faster, they are able to move faster, and I admit that China is way ahead in terms of this oil exploration, production, and whole of the activities in the sector. Even for investments abroad, many times we, when we found that the OVL, they have been outbidded by the Chinese, and we do our commercial modeling, we used to wonder, can these kind of prices, what they quote, can they be justified on commercial principles? Probably their strategy is something other than the commercial principles. So that is the difference.
Now, Mr. Tripathi, in the budget they talked about revising gas prices. How do you think that's going to play out?
The gas which is from the nominated fields, where the government administers the price, that perhaps sells at $3 to $4 per million BTU. And then there is LNG which is brought in, and that price varies from 9, 10 to 12, 13, $14 per million BTU. The price which Reliance Gas was getting was $4.2 per million BTU. So I do not know how they will be doing the averaging. Secondly, in the global scenario also, you know, the gas market is not so homogenized and well developed as the crude oil prices are. US Henry Hub prices for gas are quite low. They are in the range of $3 to $4, whereas Japan and Korea are buying LNG in the range of $12, $14 or even $15. So with so much of variation going on, and different fields will have different costing, I do not know how the government will go about funding these things.
And what do you recommend?
I think we should go for long-term agreements on gas pricing, which will make supplies stable and the prices also by a formula, so that the prices can be are based, I mean, people can predict what would be the prices in due course of time. And India should also go for long-term gas contract with Australia. But Australian prices are likely to be higher because, you know, they are not so well endowed as Qatar, Iran and some of these countries are.
And Mr. Sharma, where do you see gas prices heading for India? And what should those prices be?
You see that I see no reason that prices will not be going up, and as a sustainable model, the price of the gas have to go up, the petroleum product prices also have to go up, and you see, when another issue is that if the consumer keeps getting the subsidized the product, then there is no demand discipline. There is no pressure, motivation for the consumer to conserve on the energy. So once the pinch happens, so there is obviously then there will be some concern that they have to economize their consumption also. So that is where I feel that things should be heading in future.
And which companies do you think are going to be the major beneficiaries of a higher gas price in India?
Well, when I talk of the producer is everyone. Reliance also, if they have made high risk exploration investments in the past, so why shouldn't they get the benefit? I feel the institution of CAG also, constitutionally they have a very large, very vast mandate. But I feel there has to be more responsibility on their part also, that they shouldn't go beyond a point in that hurting the sentiments of these corporates. And let us keep in mind, it's not only Reliance now for D6. It is the British Petroleum. They are also a partner. So they are also, and not only British Petroleum, now the Shell is looking, quite seriously into investments here. They are British Gas already operating here. There are other companies also looking, but they are watching the regime. They are watching the regulatory, the mechanism here. So once the sentiment turns positive, I feel the things will move on the positive side.
Now, Mr. Sharma, we've not talked about the refining and marketing companies. What do you think the impact of these policies are going to be on those companies?
You see, R&M companies, I have all my sympathies for R&M companies. Today, if you look at the market cap of these companies, is much less than the actual asset value of the companies that they hold in terms of retail outlets, the tankages, the pipelines, the storage facilities they have. In fact, the kind of infrastructure, the value of that is much more than the share price. Share price is depressed because as of now, the investor feels these companies will not be able to make profits. They are just being kept afloat for the past many 5-6 years. They are just given adequate dose that they remain, that above the surface level they are able to show some marginal profits.
And finally, Mr. Tripathi, what is your view of the budget announcements on the oil and gas sector?
Well, no, I think there is not much that has been said in the budget. The subsidy has been reduced from 96,000 to 65,000. So it presupposes that what I had said in the beginning, that diesel prices will keep on increasing and government will not intervene to not to let the diesel prices continue to increase. Number two, it supposes that the crude oil prices will not rise.
And Mr. Sharma, what is your view on that?
Now in the budget speech, the finance minister said the current year the under recovery support is 97,000 crores. Mind it, out of this 97,000 crores, 40,000 crores has already been used up for the subsidy support that was given for the last fiscal. So balance left is 57,000 crores. Total under recoveries are 160,000 crores. Even if 50,000 crores subsidy support comes from the upstream companies, 57,000 crores comes from the government in the form of this cash support. Where from this balance is going to be met? That is a huge uncertainty, these are the companies live with. What is going to happen? Like it is being done year on year. The next year the subsidy, cash subsidy for the fuel is kept at 65,000 crores. A major portion of that provision is again going to be used up in the current fiscal so that these companies are kept afloat.
Well, on that note, thank you both for joining us. Clearly, there are a lot of delays due to differences of opinion between the regulator, the government, the Supreme Court and the oil companies. Let's speak to Sanjeev Prasad, Senior ED and Co-Head of Kotak Institutional Equities, to see why he likes the sector despite all the issues. Sanjeev, thank you very much for joining us. Let me begin by asking you, given the fuel price reforms announced so far, how has that changed your earnings estimates for the companies in the sector?
So far we haven't changed the earnings estimates. We are still looking at this process of deregulation of diesel prices, how long it can continue. Remember, it's only been 2 months, and as of now, diesel prices have gone up by about 90 paisa per litre. But in these 2 months, overall global crude prices have also gone up. So at a net level, there hasn't been much change as far as diesel prices are concerned. There has been some savings on diesel because of deregulation of diesel bulk prices.
So you favor the upstream companies over the downstream companies, correct?
That's correct, Punita. The government can keep the subsidies of the downstream oil companies fixed at a certain level, which means even if the under recoveries on products come down, it will not affect the earnings of the downstream companies that much. Whereas if you look at upstream companies, I would think as long as the government follows some fair arrangement between the government and the upstream companies in terms of sharing of subsidies, I think both ONGC and oil can stand to benefit significantly. Again, just to give you some numbers, if you look at this diesel price deregulation which we talked about, 4 rupees per litre increase in diesel prices can bring down under recoveries on diesel by somewhere about 300 billion rupees. If you assume 60-40% sharing arrangement between the government and upstream companies, that would mean about 120 billion rupees of lower under recoveries for the upstream companies. And if you look at ONGC, roughly 80% just for tax, the earnings impact on ONGC can be as much as 7.5 rupees. Add to that what we discussed in terms of impact of deregulation of gas prices, which could be as high as 9 rupees. We are looking at a potential upside of somewhere about 15 rupees for ONGC, which is about 50% of fiscal 2013 earnings. So that's a pretty significant upside. So we prefer the upstream companies a lot more than the downstream companies at this point in time.
In terms of your earnings estimates, Sanjeev, have you factored in the risk that the diesel prices do not go up as planned, and also that the gas price increases get delayed?
We have not assumed any of the upsides from either diesel deregulation continuing or natural gas prices being raised. So far, we are not making the assumption, and the way we have captured it in our target prices for the stocks is give a slightly higher multiple compared to what we would have given otherwise. And normally would give about 9 to 10 times multiples for these companies. This time around we are giving them 11 in the hope that some of this upside which we talked about in terms of diesel deregulation as also natural gas price increase would come through.
How much returns do you think investors can get by investing in the oil and gas sector today? And how much upside do you see?
If I take a realistic scenario of 3 to 4 rupees increase in diesel prices during the first 6-8 months of this year, because my sense is beyond October it would be very hard for the government to raise prices. You get some increase in natural gas prices, then I would think ONGC's earnings could be somewhere in the range of around 38-40 rupees for this year, that is for fiscal 2014. And the stock could be closer to 375 to 400 rupees, which is say about 20% upside from where we are. I think you could argue for a similar upside for most of the other stocks.
Sanjeev, are you overweighted the oil and gas sector in your recommended portfolio?
Oh yeah, absolutely. We have something like 300 basis points overweight in the model portfolio.
And what do you think is a risk to this call?
the risk is the government may increase the share of the upstream companies and lower its own subsidy burden. That would not be very well received by the market clearly.
Thank you very much for your views, Sanjeev. Clearly, Sanjeev is positive on the oil and gas sector. Now let's talk to Tanveer Gill to see what the rest of the market thinks about the sector. Tanveer, what is the rest of the market saying?
Let me begin by showing the stock price returns for 2012 for all of these stocks. The explorers have clearly underperformed the market. Reliance Industries gave a return of about nearly 20%. The oil and marketing companies, given the reforms process and the news of deregulation, from the last quarter of 2012 actually started rallying quite a bit. So BPCL closed up with almost a 50% gain last year. Coming to valuations then, and you're looking at Cairn India, Oil India, ONGC, seeing a bit of a discount to valuations across the region. ONGC perhaps is in the median range at about 9 times the FY14 earnings. Reliance Industries trade this at a bit of a premium, but with Reliance, the story is really where the value in the gas business, as well as the GRMs going up globally, this stock is likely to benefit. So 12 times seems on the lower side of the band. So BPCL, HPCL and IOC, there is some potential for HPCL and IOC to move up from here. BPCL seems a bit more expensive on a comparative basis. That's a broad call, an overview of the sector from a stock market perspective. But how are you seeing the opportunities over the medium to the long term in the sector, Punita?
Well, I would be overweight the sector, and there are 3 reasons for that. Attractive valuations. Second is positive surprises that are likely to occur in their earnings estimates. And the third reason is that these stocks have underperformed the global E&P and refining space significantly, and they've also, of course, underperformed the Indian market over the last several years. So I think with the announcements to date, a lot of this should change. So let me just talk about attractive valuations. You've thrown out some numbers. I would just add that these companies are also trading attractively versus their own last 5-year history. And given where we are today with some positive announcements, I think the situation should look better than what it has done over the last 5 years. Of course, I favor the upstream companies to the downstream companies because there are more positive triggers there, and that brings me to my point on the positive surprises on earnings growth estimates. So we've heard, for instance, with Sanjeev today, he's not factored in to his earnings estimate today the full impact of diesel price increases or a potential gas price rise. And I think probably that's the case for most of the street. And then, the third point is there has been such significant underperformance of this space versus the rest of the Indian market and versus what we've seen globally. And if you look at Reliance Industries or ONGC, even on a 5-year basis, these stocks have done nothing. So I think the reforms should help re-rate the sector, and the sector could play catch up. Well, that's my view. With that, we come to the end of this episode of Hot Sectors with me, Punita Kumar Sinha. Thank you so much for watching and have a great day.